All right, Happy New Year to everybody. So here we go, 2022. Are we going to expect much different than 2021? I'm not quite sure yet. So let's start going through some of the numbers, and feel free to ask questions on chat or chime in as needed. So here's on Market Monitor. So we're going to just start rolling through the entire MLS. So here's the median price, and it's amazing. So look at December 2021, 385 is our median price in Charleston. That's up 22.6%. We took a pretty big jump from November to December. Look at that, 365 to 385. So I was a little surprised by the 385, but from December of last year. So December last year, we were at 314 roughly. So we've jumped to 385. Look at December of 2019, we're at 275. So we've gone from 275 to 314 to 385 in a 2-year window. I haven't run the numbers on that, but that is, in 2 years, that's 40%. So we've gone up 40% in 2 years on median price in Charleston. So this is all MLS, keep in mind. So this is condos, townhomes, single family homes. So 275 to December of last year was 314 to 385. So that's pretty remarkable, but not out of line with what you're seeing and happening in other parts of the country, especially the ones placed along the coast. So where are we going from here? Well, let's continue this conversation. So price per square foot, as expected, it's up about 20% as well. So that's, I kind of pay more attention to median sales price than I do to price per square foot, but it's up about the same. Percent of original list price. So on the median side, we're still at 100. So Sean, I was thinking about this. I know we've kind of gone back and forth on what the problem was here. So the 100%, so half the houses that are listed right now are selling for 100% or higher, and half are below that. So what's interesting is that, from a standpoint of where we're at, is the median is 100. Look at the average. So when you break down the average, we got over average in, let's look back. So May, June, July, August. So your typical hot selling season, we were over average. And keep in mind, you have a time lag of 30 to 60 days. The contracts written in here, we're getting over average closing in here. So what I finally figured out, I think what the problem is there's not really a problem. It's showing that there are so many houses closing at exactly full price. There's a big swath in the middle of data points that are at 100%. So when it picks that median point, it's always at 100. So
that makes sense.
I think it makes sense when I thought about it. So, but you can see the average.
Average is working, right?
Yeah. So we crested over the average. We came down. So we're about 99%. So, we got above it. We're below it. Do we go above it again? This spring, summer, possibly so as an average, but the median still seems to be staying put. What's hard to tell is when this is actually going to go probably back down. I don't think we'll ever see it above 100, because that means you'd have to have half the houses selling over full price. But this is interesting to watch here. So days on market, let's go back to median here. So days, yes?
Sorry, back on the percent of original price, what was the November to December move this year versus last year? And
so
price and the percent. So go ahead. Okay, 20 grand. Okay, I'll do the math.
20 grand.
Thanks.
And that's 5.5% last. If we go back a year, it was actually down November to December.
Yeah.
So this caught me a little off guard. It was that much of an increase, because that's a pretty significant move November to December, but it is what it is. So
it's also consistent. Look at the percent of original price. It went up back on the percent.
Correct. Yep. Yeah, we started going back up on the average. Yep.
And what did it do last November, December, percent of original price?
So last November, December, we were 97.8 and 97.6.
Okay,
So I mean,
So
we've
that-
jumped quite a bit.
that's a anomaly then too. Okay, thanks.
Yep. So median days on market, so we're at 5. So again, median is half the houses are selling in 5 days or less. So I think that's the best way to explain it to your sellers and or buyers, is half the houses are selling in less than a week, half are taking longer than a week. But if you look at the average, so we got down to 14 in July, and we've been drifting higher since, and we got to 22 in December. Now, part of that is seasonality. It generally will slow down a little bit in the winter. So, I mean, if you look at, if we go back to what we were hoping is a traditional year, let's say 2018, see where we're higher, we dropped in the spring, summer, and we came back up in the winter. So the rise in the winter is not surprising. So watch this average going forward. If we go back down once we hit the spring and summer on an average, the median has been slightly drifting higher, but not by much. So watch these closely for trends, and I'm very anxious to see if this kind of goes back down on a seasonal basis or if we're trending higher long term. Months of supply. So months of supply, we've drifted down, and we had so many closings with so little inventory in December. We're only at 0.7 months of inventory. When you look at the traditional time, we should be around 4 months of inventory. I mean, I would say 18 and 19, I don't think it really felt like one market or another necessarily, like a buyer's market, seller's market. It felt fairly balanced. So, I mean, we've drifted from 4, low 4s, and then we've gone down again in the winter. And I think this is being driven by how many houses are actually, how few houses are on the market compared to how many are closing. So, we're back down to 0.7 months of inventory on the months of supply. We'll watch as the inventory goes up. We'll see what happens here. Homes for sale. And again, there's a little bit of a lag here. So we had at the end of December 1,427. We saw under 1,300 the first couple of days of the year, which matches the low we hit back in May. So May, and again, I don't quite understand Market Monitor how they have 1866, because we got down to 1,289 in May, and we're back down to about that same number today. So we've gone up this week from roughly 1,300. We're about 1,350 right now, but that's your traditional weekly trend. By the time you get to Thursday, Friday, Saturday, it's a higher number. So again, this is a number to watch very closely. I mean, again, anybody who knows me and has been in my office in Mount Pleasant, I write down, we write down the numbers every day. Between 9 and 10 in the morning, we want to see what that inventory is at, because we want to be some of the first people to know things are changing. But you can see back in 18, 19, we're about 6,500, 6,000. We have more people living here. I mean, I think if we have a balanced market, we probably need to be about 7,500, 8,000. This didn't feel, 6,300 didn't feel like necessarily high or low inventory, but we have quite some time to get back there. That's not something that's going to happen tomorrow. So, year over year, we've lost 50% of our inventory in 1 year. So it's quite remarkable how much that has dropped. And again, for trends, for anybody who's following this, pre-COVID, so 2 years ago, we had 5,600 for sale. So 2 years ago, 5,600. A year ago, so January 1st of 2021, we had 2,337 for sale. And then basically January 1st of this year, we had about 1,300. So we've gone from 5,600 to 2,300 to 1,300, which is quite a remarkable, and we were higher than that, back in 19 and 18. Now, for perspective, if we go back in time, we had 12,000 houses for sale in the recession period. So August of 2007, basically 2008, we had about 12,000 houses for sale. We have 10% for sale right now than we did have 13, 14 years ago. So that's why I have about 50 signs sitting in my garage, is because I had a lot of listings back then. Now they turn over so quickly, you don't need signs. You don't need as many signs. So, but we have 10% of what we had, 13, 14 years ago. So I know a lot of you have not been in the business for that long, but that's what was happening back then. And some of you that have, we felt the pain right in here. So homes for sale, let's zoom back in. So we'll come back to more recent. So watch that daily trend. Are we going higher or lower? We expect, normal market is we should see more houses for sale in the spring and summer. Again, if you look at the trend, you can see there's more activity in the spring and summer of listings. So that's not surprising. It's just, how much do we come back up at this point? Closed sales. So we were off almost 8% on closed sales year over year. I think you can probably attribute that. So, we closed over 2,000 last December, under 2,000 this December. I think a lot of that can be attributed to there's nothing for sale. We had 50 to 60% more for sale last year, which allows you to close some homes. If there's only 1,300 for sale, how are you ever going to close 2,000 houses? So that's why a lot of transactions are happening off of MLS. And, as soon as they're entered in MLS, they're already under contract. Is that to keep up 2,000 sales a month, you have to have more than 1,300 for sale. But you can see this is interesting. If you go, so we're looking each month, right? So you can do rolling 12 months. That'll add up the past 12 months. So the past 12 months, we've sold 24,117 homes. So we have averaged 2,000 sales a month for the past year. We've never been anywhere close to that. In, let's say, normal times, 18, 19, we're about 18,000. That's 1,500 homes a month. We got to 24,000. You can see this drift down. And remember, this isn't, when you do the rolling 12 months, it's taking away any seasonality. So you can't argue data points on seasonality if you're looking at 12 months. So you can see we peaked in June. So from June 2021, going back 12 months, we closed almost 25,000. So we've been drifting down over time. And you can see this skyrocket up after, the shutdown and then drifting down. I think we just run out of houses to sell. We don't have enough inventory to keep up the pace of 25,000, and we're drifting down, on an annual basis. So it's something to watch. And December is a good example. We flip back to the monthly. We were 8% below in December. What is January going to look like? So last January, we dropped off to 1445. Because remember, January and February are generally the lowest closing months, no matter what year you are. So here, back to 18, look at the low, January and February, and then jump in March. And then you go back, and January and February and the low, jump. So, from that aspect, if you look at that 8% reduction, are we going to feel that in January? I don't know, but watch, where we're at. And if we're losing that number of transactions year over year, I think a lot of that has to do with the fact that we just don't have enough homes for sale. So new listings. So on the new listings here, we look at this number. So we're off almost 4% in December. So we listed 1,410 homes in December. Last December, we were 1,464. So, we were actually higher, from that standpoint a year ago. Again, a lot of transactions are happening off the market, but this is always, and I tell people that this is the one chart that you don't really kind of notice the difference from 18. Look at the curves, 18, 19, 20, 21, right? It kind of looks similar, doesn't it? There's nothing really significantly different that would say a dramatic event happened in this window here. So we're putting houses in the market, but no different pace than we are, but the closed sales jumped. So let's look at the same thing. You can tell it closed at a different level. We were peaking at 2,000 sales in the highest months of 18-19. Now we're rarely below 2,000 unless it's a seasonal low, January, February. Because remember, January and February, those are the contracts that are written in, December, Thanksgiving, Christmas, New Year's. of course, those are going to be the closing results of January and February. So that's normal. Don't freak out that there's not that many closings on your books for January, because I think Jan Snook has a bunch. But from that aspect, this is the normal seasonal trend. And traditionally, if you look at the normal is the low month to the high month is almost double. So, you're around 1,000, 18, you're around 1,000 for the low, 2,000 for the high. Around 1,000 for the low, 2,000 for the high. That is historically, that's what we're used to in Charleston. Now, it's hard to argue like 20, so we're 1,165, we almost got to 2,500 for the high. But again, that was because we missed a whole bunch of closings in here when the market was completely shut down. But if you look at here, we were about 1,445 in January. We got to 2,500. Where are we going to go from here? I think it's all a matter of how much inventory we can, get on the market. So if we look at new listings on here, so we have, so the new listings, again, we're hitting a low. We'll see where it goes from here. Pending sales. So the pending sales, you can see we're off we're higher by 6%. So we have 1619 pending at the end of December. If we go to the end of December last year, we had 1528. So we're actually higher this year than we were last year. Now, is some of that new construction that's not going to be done for 6-8 months? Maybe so. So you don't necessarily know that, January and February might be good closing months, because some of those could be very delayed closings that are just on the books as a pending sale in MLS. But it's interesting to see that pending sales, this is not out of the ordinary to watch that drop off in that time period there. So we go to dollar volume. Dollar volume should be near and dear to every agent's heart, because this is how we get paid, right? So look at the dollar volume. We had, if we go, and again, January, February, the low, but look at starting in March, over $1 billion, over $1 billion, over $1 billion the whole time, except for September was a little bit lower, only 900 million. So just for, that's the start of school closings that sometimes, that's not ideal time if somebody has kids to be moving. So sometimes that is a slower time period. So then we had November was a little bit slower, but look at December, we eclipsed $1 billion in sales again. So we're up 14.6%. From a year ago, up 14.6% in volume. But I also wanted you to look at the trend in 18 and 19. Look, we were making 700 million as the peak. In June we did 765. 18, we have not had, other than January and February of last year, we have not been below that number the entire time. So if you do a rolling 12 months, this is kind of a telltale sign.
Yes.
Look, we're at almost $12 billion. So we almost did $12 billion in the past 12 months. So that's $1 billion a month, up 30% in volume the past 12 months.
These are the builders.
Sorry, say that again. So we're up 30% in the past 12 months. And when you look at that, you can see we're struggling to get higher than that. And I think that is partially because there's just not enough homes for sale. You can see this straight line up from June of 2020 to June of 2021, but then struggling to get higher. And I think it really has to do with we just don't have enough for sale. I'm going to mute. If you're not muted, if you can mute yourself, I hear some background noise. But so we're at $1 billion a month, and I wanted to put that in perspective. Look at back in 18 and 19, we're about $6 billion for the year, right? We're double the volume we were in 18 and 19. So the volume has doubled in the past 3 years. And part of that is number of transactions, and part of that is sales price. So, that all equates to volume. Shows to pending. So here's the shows to pending. For to crunch the numbers. So we're about 10, sorry, this is doing a 12-month average. So here's the monthly. So, we're sitting about 10 shows depending. Again, this is another way to have a conversation with your sellers, is that if you go past 10 showings, you're past the median. So, houses that are selling in 10 showings or less half the time. So if you're getting past 10 and you haven't sold, there's probably a good chance you're overpriced. Unless you have 30 showings the first day, then you're fine. But I guess, a normal showing pattern is that if you get past 10, you're probably priced too high. Shows per listing, waiting for it to turn to numbers. So, we're sitting about 7.5. So this is, again, a good reference point. If you're not getting, the 7 showings in a month, keep in mind this is a month. So if you're not getting 2 showings a week, then something's not right with your listing. And you can see the showings jump from 18, 19 up to where we're at. A lot of that has to do with there's nothing for sale. So you can't tell me you can get a buyer in your car and take them to 8 houses. I don't think you can in a lot of places. You're having to one-off show them. Like a house hits the market and you run out and show them. And then a week later, another one hits the market and you run out and show them. It's hard to put people in your car and go show them 6 to 8 houses. That almost doesn't exist anymore. So, again, that's the market as a whole. And I wanted to kind of, put some perspective on where we're at. To be at 385 with 2,000 sales a month, that's how we're averaging almost $1 billion a month in transactions. So, you can break down on here. So I just wanted to break down for you. Can go and say, okay, let's look at, we're just going to pick Mount Pleasant out real quick. So if we go look at Mount Pleasant, you can see, so the difference is, so the median price, and this is interesting, is 18.9%. So it's not quite what the market as a whole is. Again, we're dealing with a much higher price point. We're dealing with the 630,000 median versus 385. But you can see the increase from, 19 and 20, we were sitting about 485, now we're about 630. But I did want to show to you, I think what it was, days on market. So we're about 4 days on market, so a little bit lower than the average. But look at the months of supply. So Mount Pleasant right now is 0.3 months of supply. I don't think in my 20 years I've ever seen a lower number than this. So what's happening is there's nothing for sale in Mount Pleasant, and we are closing. So in December, there were 215 closings in Mount Pleasant. And I know I looked at, I think it was January 1st or 2nd, there were only 84 homes for sale. So how can you close 215 in a month and only have 84 for sale? So what it's showing is that months of supply is so low that there are so few choices for buyers to look at because there's so many buyers relative to the active listings. So you can go look at, and months of supply, and I know I've said this several times, months of supply to me is always the number one thing to look at. As far as if you can only know one data point, tell me months of supply. If I want to learn the market in San Francisco or Boston, it's like, what's the months of supply? Because that's going to tell you all the dynamics happening around you. The economic growth, the unemployment, the interest rates, any political events, COVID, everything boils down to, it all funnels, and the end result is months of supply. So again, I want to put perspective on this for everybody. Let me go back. I want to go to all again. So we're going to go to all. So here's our months of supply. So the entire MLS is 0.7 months. So for reference, Mount Pleasant is twice as fast as the Charleston market as a whole right now, based on supply and demand. So let's go back in time. So if we go back, and again, this is entire MLS again. So pre-recession, the fastest we ever got was 3 months. So 3 months of inventory, the best way to look at that is if there are 3 active listings this month, one of those is going to sell. So so here's 3 months of inventory. If we go back, May of 2009 was the low point, if you want to call that, in the market. We had 17 months of inventory. So out of 17 listings, 1 was going to sell that month. So here's one extreme of 3, here's the other extreme of 17. And we worked our way down over time, and we finally got to a stable. So look how, I'm going to say stable. So look at, we worked off our inventory, and look at 16, 17, 18, 19, really not much of a change. Yeah, you can see the seasonal, right? You can see the up and down the seasonal, but sitting right about 4 months of inventory. And then there's a time period here, and I'm going to zoom in a little bit. So there was something happening in this market prior to COVID, because if you look at where we ended up December of 2019, maybe there was a couple little articles about COVID, but it was not a prevalent event. So we were about 3.5 months of inventory. The December before, we had been 3.9. So 3.5 was a low number we hadn't seen in a while. So the market was already kind of gaining momentum right in here, and then COVID just sent it over the top. So there were more dynamics than that, you know, the underbuilding, you know, the low interest rates, millennials turning home buying age. There's a lot of dynamics, not just COVID, that, you know, related to this, you know, the work from home, all of that drove our market to where we're at, down to 0.7 months of inventory. So if we go back in time, again, 17 months, so we're down to 0.7 months. So if every house is priced right, every house can sell this month. The ones that aren't selling aren't at the right price. So we've never been, remember, 0.7 months, the low pre-recession for those of us who are in business was 3. So we're 4 times faster on absorption right now than we were pre-recession. So just the extremes that we've been in, and this is, for all intents and purposes, this is the normal market period right in here. And I know we shoot for 6 months of inventory, you know, as far as a balanced market. I think if you're in that 4 to 5 range, it's going to feel balanced, especially from what we're related to today. The question is, how long does it take us to go from 0.7 months of inventory back up to 4 months of inventory? And I mean, I wish I had an answer to that. You know, when we only have, as of, you know, today it was 1,350. As we only have 1,350 for sale, I think we have to get back to 6,000 to 8,000 for sale for the market to kind of slow down, if you want to call it that. Look at the homes for sale in here. So if you start in 13 and you go all the way until, and again, middle of 19, something started changing in here, because that was a pretty big drop off. And, you know, if you go all the way to middle of 19, we were sitting around 6,000 to 6,500 for sale. That was very kind of normal after we worked off our inventory from 12,000. So we have a lot more people living here today than we did back here. So, I mean, we had 12,000 houses for sale in 7 and 8, and we have 1,350 today. So we have 10% of what we had back here for sale. So the 6,000 to 8,000, is it going to happen in 2022? I don't see how that's anywhere possible. Is it going to happen in 2023? I would be shocked at that as well. So, I mean, I think we have an under inventory, like too much demand compared to the supply. I think we're here for another couple of years. I don't see what's changing that's going to change that dynamic. You know, we have supply chain issues for new construction. We have labor issues for new construction. So they can't build fast enough on something that they're already behind. And if you read, there's Zillow came out with their estimate for home price changes for 2022. And the median for the U.S. is 14, I think it was 14.4%, let's say 14%. So 14% is the median for the U.S. as a whole. They had their top 10, and they only look at the top 50 markets on a population basis, of which we are not one of the top 50. So they don't have an exact estimate for Charleston. But if you look at the top 50, in the top 10, you have Charlotte, you have Raleigh, you have Atlanta, you have Tampa, you have southeastern cities dominating that top 10. So if those areas are in the top 10, we're in the top 10. You know, how can we not be compared to those cities? And so we're in that same area, you know, same climate, same environment, same economic environment. So we are they had Tampa as number one on their estimate for increase in value. They had them at 24.6%. So let me go back to sales price here. So they had Tampa at 24.6%. So I'm going to zoom in here a little bit. So in the top 10, you know, they're probably all above 20%. They had number 50. So the lowest area that they had for appreciation estimate for 2022 is San Francisco. And San Francisco, they had at 9.9%. So think about it, the top 50 areas, the low they have is San Francisco at 10%. The high is 25% essentially. So where are we at? I mean, again, you know, it's a guess from Zestimate from the Zillow on where they're at. But how do we have this low of a supply and this high of demand and not think that we're going to be up in this? I'm not saying we're going to eclipse 2021, but we're going to be higher on price in 2022 because even the first week of January, you're running into multiple offers all over the place. So what's going to happen this spring? Is it going to feel that much different than last spring? I think it's going to feel. So remember, last year we started it with 2337 for sale. This year we're starting with 1300 for sale. So we're starting with 40% less. How is this spring going to feel any different than last spring? I don't think it can. You know, we are in this market for a while longer, and until we get some more supply, it's not going to change. So you have to prepare your buyers that it's still going to be a very competitive year for them to purchase a house. And you know, from the seller aspect, you know, anybody who says there's a real estate bubble, I just can't see. Here, I'll show you a real estate bubble. So, because a lot of us lived through this, and here's a real estate bubble right here. So look in Charleston, and this is why I lived through all this. I went through 9/11 in real estate. I went through the recession, you know, and I'm in it now. And where we're at is in 2005, we had roughly 4,000 for sale. But look what happened. We went to 12,000 for sale. So we tripled our inventory. And we tripled our inventory and lost the buyer demand at the same time. So that's why it's so important to watch the supply and demand. And you know, I'm sorry, but I don't see how, you know, on an economic basis, our low was middle of 05. We hit our peak inventory in August of 2007. When did everybody say the recession happened? 2008, right? How did nobody see the housing recession come with all of this happening here? It kind of blows my mind that, you know, we were so far ahead of ourselves, but the data was saying there are problems coming. And it took us a long time to work out that inventory. You know, unfortunately, I think it's going to take us a long time to build back up that inventory. So I know I harp on, you know, the inventory count, but you can't, as an agent, you have to watch what's happening and be ahead of any sort of change in that curve. And that's why we watch it on a daily basis. We want to know when the change is coming. But for us to be at 4,000 units back in 05 and only have 1,300 today, you know, we're a third of the listing inventory we were in this booming, you know, real estate business right here. So with how many more people live in Charleston area in 2022 compared to 2005? I don't have the number. I'm just kind of putting that out there. It's a lot more, right? So we need more than 4,000 for sale to have any sort of normalcy in this market. So again, you know, we'll watch these numbers throughout the year, but you can use Market Monitor and areas that you work in. You know, pick areas you want to look at. I mean, you can go down to a specific area. I mean, we can go, let's just pick downtown. So here's inside the crosstown. You can break it down and look at a specific area. I'm going to zoom back out a little bit. So here's the monthly, and you know, there's not as many transactions downtown, so it can be a little bit more. So if you go to rolling 12 months, it kind of shows a better trend because it has more data points. But you can see the trend is higher downtown on pricing. But look at the months of supply. You know, there's a time lag of downtown compared to the rest of the market, but it is still improving. We've gone from 12 months of inventory January 2021, and we've dropped, and on an annual basis, we're down to 4.4. But if you look at monthly, look, we're down to 2.1, right? So there was a time lag of downtown improving compared to the rest of the market, but it is still a downward trend downtown, which means that market is heating up still.
Was downtown ever 2.1? Was downtown ever that bad before?
I don't think so.
Mm-mm.
I mean, the low we hit pre-recession downtown was around, let's call it 5 to 6, right?
Yeah.
So 5 is the low. We're down to 2.1, and you can see downtown was not necessarily flat into 19 and 20. It was on an upward kind of trend, and then it's improved dramatically since then. But again, remember so this is the recessionary period. 54 months of inventory south of the crosstown, below the crosstown, 54 months of inventory. And again, I can't stress the importance of this. Is like back then, you had 54 listings, one would sell that month. So that's how dramatically different the market was back then. Now you can have 2 listings, and one of those is going to sell this month. So that's why prices were falling here and why they're rising here. It all boils down to supply and demand. So again, if you don't have time to follow all the numbers, look at the supply and demand in any area that you're working, and it's going to tell you what the market's doing. Here's James Island. So here we are, we're at 0.4 months of inventory in James Island. So James Island and Mount Pleasant look pretty similar on months of inventory. But again, look at the recession, 17 months of inventory. So, but that 0.4 months, how are prices not going up in James Island? They have to be at 0.4 months of inventory. And you can go to, just about any area. So here's West Ashley inside of 526, 0.5 months of inventory. So, and you're going to see the trends for any area are going to be positive. So let's go, and we'll do Isle of Palms. So 0.7 months of inventory, in December. And look, they were 90 months of inventory in the recession. So this is all the speculation, and this is the result of it. But we are in an environment that's nothing like we've seen before. I mean, even in the hottest moments, it was 3 to 4 months of inventory. So, you can go pick any area. And again, it's good relationship to see where are we at and where do we go during this year is follow if you work certain areas of town, follow those numbers for those areas. I know on January 1st, there were 84 properties for sale in Mount Pleasant, and that was it. So you've got a town of 90,000 people, and there's 84 properties for sale. So that is such an imbalance. It has to, prices are going to continue to go up until the supply and demand start to level out. So anyway, anybody have any questions for the day or comments that they'd like to share? But if you do want to, this is being recorded. So if an agent in our office didn't get to join us, then they can certainly go back and listen to the recording. But this is kind of the goal every month, is the first Friday that the data is out every month. We kind of look where we are that month so we can kind of, predict ahead of where we're going. But, again, and I'm not saying Zillow is going to be right or wrong, but I can't see how we're not going to have double-digit increase in prices this year. We're starting from a lower inventory standpoint than we did a year ago, and we experienced 22.6% increase in price. So I just don't see, and again, the year is starting out with multiple offers. I mean, I don't know how many of you have been involved with multiple offers this week, but it's happening, and it's only the first week in January. So, I mean, wait until we hit that traditional, spring market, and it's going to continue that route. So,
Anton,
well, I hope everybody, yes?
Any thoughts on interest rates? Your current thoughts, I should say.
I mean, everything I read, they're saying 3 increases on the Fed rates this year. Most of what I'm reading, I'm guessing second quarter there's one, third quarter there's one, and fourth quarter there's one. But most what I'm reading is you're probably 3.75 for interest rates by the end of the year. I think we all got very accustomed to seeing low threes, but 3.75 historically is still a fabulous interest rate. And it all boils down to housing affordability, right? You're either a renter or a homeowner. You have to be one or the other. And the rent rates have been going up like crazy as well. So if your options are to rent for a higher price or buy for a higher price, as long as the payments are less, you're still going to opt to buy. If you have the credit, the income, and the assets, you're still going to opt to buy. So I don't see where, part of what happened back in the recession was there were so many vacant houses that the landlords started dropping their rent. And when the landlords start dropping their rent, there's a disincentive to buy because your rental rates are lower than your purchase rates. So that's part of what happened in here. We had too many vacant houses that dropped the rent rates. Right now, how many vacant properties are there? I don't see many. And keep in mind, so, and I just do this just for my knowledge. I looked at the Jasper building downtown, the new rentals in the Jasper. There's 221 units in there. There are only 2 that aren't spoken for. So they have 99% occupancy, and the 2 that aren't spoken for, and this blew my mind, the rental rates on those 2, and again, they're the top floor and the next to top floor. The rental rates on those 2, $13,000 a month. $13,000 a month to rent a place in Charleston. That's $150,000 a year that somebody's spending for rent. And those 2 floors, there's 10 units in each floor. 9 of those 10 are rented. So I assume those other 9 units are rented around that rate. And it's just the cash that's coming in and the money flow that's coming into Charleston is phenomenal. Because I would never have guessed that somebody can plop down $13,000 a month to rent in Charleston, but here they are. And so when you look at those rental rates, it's still cheaper to buy in a lot of cases. So anyway, just watch vacancies, on the rental side, because that does affect the buyers and sellers, because it's a, hey, if it's $2,000 a month for me to rent or it's $1,800 to buy, then they're going to buy. If it's $2,000 a month to rent and it's $2,500 to buy, they're going to rent. So there's that fine line. And right now, both the rental prices and the home prices are both going up. So there's not a winning dynamic at that standpoint that one's, winning out over the others. So,
where's our inventory come from? Because we talk all the time. Unfortunately, these guys aren't privy to our conversations. But we talk about our local market. Like, what is the incentive for more inventory to come on? Like, for me to move from my house, what am I going to go buy for? Like, what I could sell my house for? What, right? Like, my move up home is my house.
She was coming back. Right. She might be down in our other office right now.
I think that's the big challenge with where the market is right now, is that the local people that traditionally would move from house A to house B, they're not moving at all because they don't know where they're going, and they keep getting beat out by people from out of town that are offering either cash or no contingency. And I mean, if you put your house on the market right now and you don't have a place to go, you might lose out multiple times on multiple offers moving forward trying to secure a house. So these local sellers / buyers are very hesitant to put their house on the market, even if they want to move, because they don't want to make themselves homeless. And you have to keep in mind, if rates go up, for those of you, maybe we have short-term memory, but if we look back, at the end of 18, rates were 5%. So I had somebody close a house at 5%, but that was the rate. It didn't seem high or low. That was the rate, right? So we've gotten so accustomed to like 3% interest rates that when rates go up, yes, it could slow down the buyer demand because it's going to make housing less affordable. However, at the same time, what's your incentive as a seller? If you own a house currently and you're at 3% or 2.75 or 2.5 or wherever you're at, and rates go to 5%, what is your incentive to sell your house? It's almost zero. Because if you go from 3 to 5, you're increasing your interest payments by 70% almost without any difference in price. So if you're going to upsize your house or move to a higher end house, you could be doubling your payments. What is that seller / buyer going to do? They're not going to move. They're going to renovate their kitchen, add a bathroom, they're going to renovate their house. So the risk for us as agents is more transaction count based than, a deteriorating market. It's a transaction count. If you can't get the sellers motivated to sell their house because they're locked in at such a low rate, then you lose a seller and a buyer transaction. So it's a matter of, it's dynamics that we can't, there's forces at play that we're not going to be able to control. But we've never been, I've been doing this 20 years. I bought a house in 2001, so 21 years ago, at 8 1/4 on an arm over here in Bell Hall. But that was the rate. It wasn't high or low. It was an arm at 8 1/4. So for 20 years, we've been in a, for the most part, declining interest rate environment. I think the government's going to have a hard time letting these rates go up too quickly. So I think it's going to be a very controlled event where it's slowly changing. But over time, if you already own a home, I had a buyer a year ago buy a house for me, first-time home buyer, and she got 2.5% on a 30-year fix. And I looked at her, I'm like, you're never going to sell this house. Like, if you want to live in a different house, that's fine. But 2.5% for 30 years, you just need to rent this out when you're done with it, because it's such a good investment for you long-term to have that locked in of a low interest rate. So the dynamics at play as we move forward, as interest rates go up, is you're going to have a really hard time convincing local sellers to move for a benefit, because when they're going to look at their payment, they're going to be in this sticker shock of leaving their interest rate. Somebody moving from Chicago or Boston or California, they don't have a house in Charleston at a low interest rate. So it doesn't matter as much if it's 3, 4, or 5%. Maybe they won't buy that $800,000 house. Maybe they'll buy a $600,000 house, but they don't have a house in Charleston at a low interest rate. So they're not using that as a relative reference point. But your local people, it's going to be a challenge when they look at their numbers financially and say, well, why would I double my payment for a slightly nicer house? They're just not going to do it. Yes, you're still going to have situations of, death, divorce, marriage, job transfer. You're going to have those situations, but the ones that just want to buy a different house, those are going to be the challenges. So, and again, you're going to, as time goes forward, you're going to experience some of these things and relate back to, some of these conversations. They're coming at some point when the interest rates go up. So, so you got to be diligent at watching the numbers and seeing what's changing in the market. So,
Anton.
Anyway,
Can I ask a question? Do you ever
Sure.
track anything regarding land availability? And I know obviously that you can't really get construction workers to build for you, but I'm just curious on what your resource is for that availability. I know a lot of people
So
are looking at that as an option.
Yeah, well, here you go. Here's land, right? So we went from, you can click on land. So we just went from residential to land. So land, let me get back on all areas. Yeah. So here's your supply. Homes for sale, should say land for sale. But we had pre-recession 1,500 lots. Then we got up to 5,000. Look at where we're at today. And I think if you look at today, we're under 1,000. So we have under 1,000 lots where we had 5,000 during the recession. So the problem is you can't even find the dirt. You can't even find the dirt.
So the resources for Market Monitor is MLS, is that correct? So
they're pulling, Market Monitor is pulling their data from our MLS.
Okay.
So, they're compiling, and again, there's not much use in checking it other than once a month, because they basically compile everything for that month, because towards the end of the month is most of your closing. So if you're going to be religious at checking Market Monitor, check it once a month, the first week of the following month, because all the data is updated. But, when you have under 1,000 lots for sale, and this is, custom lots, right? This isn't like Lennar and the big D.R. Horton builders. This is custom lots. But that drop off, what's happening is there's not as much incentive as the developer to make a custom lot subdivision sell off the lots when they can just, Lennar or D.R. Horton or the big players can just write a check. So, for all the lots, and that's what's happening is you don't have as many custom unique opportunities, but then you have the big players in the business taking down big tracts of land and controlling that market. A lot of these big builders, they have control of that neighborhood. So they're going to keep ratcheting up their prices and control the inventory. And these big builders, they got behind because everybody got so burned in this recession here. And if you think about it, the people that were working at these companies in here are probably making their way up to management level and higher level executives in here. They felt this pain. So they were very hesitant to stick their neck out in 2016, 17, 18 and take on huge tracts of land and develop a lot of property. So we are so far behind. And I think I shared this the last time, is that between 2010 and 2020, there were 12 million households created in the US. We only built 7 million units. So they're 5 million units behind, and then the whole COVID implosion happens, and owning a home becomes so much more important. So they were already behind, and I think that's part of what we started to see in 19, is we were so far behind on building, and then you everything else comes up on top of that, lowering the interest rates. You remember, rates, again, they were close to 5%, and then they came down to 2.5% to 3% in a lot of cases. That's twice as affordable, right? So if you were buying a $500,000 house, you could buy $1 million house at the same interest rate, at the interest rate, because it had cut in half. So it made everything so much more affordable, and that's why we saw this drop off. So, we're at the mercy of these Lennars and D.R. Hortons. The neighborhoods that they develop, that's the future right now, because we only have 1,000 lots for sale, and it's not increasing, right? It keeps going down. Nobody's doing custom lots at this point. It's all tracts of land being sold to the big developers. So, that's why you're seeing this continue, and this is going to continue to drop throughout this year. It's not going to change. So, but you can look at land just like you can residential. So, all right. Well, I think that's probably all I have for today. But I appreciate everybody joining us, and I'm always around if I can help with any questions. But play around with Market Monitor once a month, and you're going to learn a lot. So, everybody have a great weekend out there. Again, be safe and good luck out there. We all need it.
Thanks so much.
Bye.
Thanks a lot.
Bye.
Thank you.